my favorite asset on the earth. It is the most undervalued asset on the planet. And there's number 2 right there, gold. I think commodities across the board are so incredibly undervalued based on global debt. I sincerely believe, through everything I look at and all the research that I have done, and look at this background history, we are going to get a 1-to-1 ratio. Gold, Dow, meaning if Dow 8,000 happens when the debt market implodes, because everyone's staring at the stock market, okay? Because that's what the mainstream media wants you to look at. So Dow gold ratio 1-to-1, Dow 8,000, I don't know. Let's say it's 10,000. I think gold's going to get to 10,000. Whatever the Dow bottom is at that point during a full-on meltdown in the debt market, which is where people should be looking. It's the debt market dictates everything. It's affecting.
The silver rate has been heavily influenced by weak industrial production and a lack of global investor interest. However, if the continued focus on the energy transition is accompanied by stronger global growth, silver prices should exceed the $50 mark. Often referred to as the Robin Hood of Wall Street, Gregory Mannarino is renowned for his innovative financial strategies. Gregory Mannarino highlights silver as the most undervalued asset relative to global debt. He suggests having some exposure to Bitcoin, especially under a supportive administration, but maintains silver as his top investment choice. JPMorgan, one of the largest investment banks, has predicted that silver prices will soar in 2025, led by different factors, including increased demand from the expected monetary shifts and silver's value as an inflation hedge. Reflecting on market history, Mannarino explains that the stock market is disconnected from reality due to easy money, predicting significant price distortions. He foresees the Dow potentially dropping to $8,000 at some point in the future, aligning with a 1-to-1 ratio with gold. Mannarino predicts a debt market meltdown, which would drive yields up and push cash into undervalued assets like gold and silver. Despite the bear market experienced by gold since September 2011, gold has gained 328% since 2001 versus 79% for the DJI. Since gold became free to trade in 1971, gold has proven to be a superior investment, despite periods of underperformance. The best reason for following the Dow-gold ratio is to help determine whether one should be in gold or stocks. While gold topped in September 2011, the confirmation that the tide had shifted in favor of stocks did not happen until 2013. On April 12 and 15, 2013, the gold market broke down when parties unknown offered the equivalent of 400 tons of gold in the futures market at the open all at once. According to him, the Dow-to-gold ratio will change dramatically, as both will ultimately equalize. Now, we present the clips of Gregory Mannarino's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I'm not telling people to go all in on anything. In my view, people need to understand where they should be putting the currency to work here. And whether you're in the market, you need to at least have exposure to commodities here. As you said, silver, my favorite asset on the earth, bar none. It is the most undervalued asset on the planet. And there's number 2 right there, gold. I think commodities across the board are so incredibly undervalued based on global debt right now. And it's no accident why this is going on here. I also think people need just some exposure to cryptocurrency, especially Bitcoin with Trump, with his Bitcoin president, crypto president, what he's saying about Bitcoin stockpile. I mean, look, I know the space isn't for everyone. And I know there was a time when Trump was an outspoken hater of Bitcoin and crypto, but he's turned around. He's turned around for some whatever reason, okay? And if he is selected, this is going to be a very good place to be in. If he's not selected, you can see the crypto space take a hit, absolutely. But I still think in the long run, it's going much, much higher. But still, it doesn't change my perspective that I still feel silver is the place to be. If you had only enough cash, people, and this is just me, you do what you want, do your own research here, to just hold one thing, one and only, that would be silver. I mean, what I look at, and I don't just come up with this, people say, well, Greg, how do you come up with this stuff? It's just too easy, okay? I just look back on history. History is a good teacher, okay? I look at where the stock market is today. It's absolutely disconnected from reality because of easy money that's being pumped into it, and a lot more is going to be pumped into it moving forward. That means the price action distortions across the spectrum of assets, classes, is going to get much more dramatic. If we understand that, okay, Okay, that's an easy place for us to take advantage of it. But we also have to think about, okay, where's the bottom? We know it's nowhere near where we are. I just look at it this way. When the Fed stepped in here, it's too easy. Okay, when the Fed stepped in here with QE1, the Dow was cut in half. It went from 12,000 to 6,000. The Fed stepped in here with QE1. So is that a prospective bottom? Is it higher than that? Would the market have gone lower if the Fed didn't jump in? Obviously, yes. We probably would have went down to Dow 4,000, maybe even 3,000 at that point. But if we just can try to surmise where the bottom of the Dow is, let's say it's 8,000. I sincerely believe, through everything I look at and all the research that I have done, and look at this back on history, we are going to get a 1-to-1 ratio, gold Dow, meaning if Dow 8,000 happens when the debt market implodes, because everyone's staring at the stock market, okay? Because that's what the mainstream media wants you to look at. They don't even want people to look at the broader market or the S&P. It's just 30 companies. That should tell people something anyway. Look at the Dow. Look at the Dow. Dow's important, no doubt about it. But you should be looking at the broader market. Anyway, I just look at the Dow gold ratio. I believe this market is so massively overvalued that we really could see a full-on meltdown in the debt market, meaning debt will sell off. Yields are going to spike in a massive way. And that's going to put pressure on the stock markets around the world. All the cash is going to bleed out of it. Doesn't go to money heaven. It just flies into other assets, really. And I think it's going to go into suppressed assets here. So Dow gold ratio 1-to-1, Dow 8,000. I don't know. Let's say it's 10,000. I think gold's going to get to 10,000 or whatever it might be. Whatever the Dow bottom is at that point during a full-on meltdown in the debt market, which is where people should be looking. It's the debt market dictates everything. It's affecting everything, including the carry trade, including real estate, now all this kind of stuff. Everything is priced off of the debt market. In fact, everything could be considered a derivative then of what's happening here in the debt market. It's too easy. Understanding where the Dow could potentially go here, it just makes it a no-brainer to understand where you should be. And with regard to right now, the Dow gold ratio is, what is it, 60, 80, whatever it might be. We're going to go to 15-to-1, 10-to-1 in an extreme. So that's where I get this from. I don't pull it out of a hat. I don't even think about the price. I tell you the truth here. I never even think about the price action of gold or silver or even commodities right now. I just know where it's eventually going to go. Commodities are real things. We're eventually going to see this come apart by design.
During the interview, Gregory Mannarino observed that we are entering a period of seasonal market volatility influenced by geopolitics. He underscores the ripple effect on various markets, including currencies, noting that central banks are buying up debt, causing significant drops in the 10-year yield. Right now, the government is running a primary deficit of roughly 4% of gross domestic product, with the inflation-adjusted interest rate at about level with the growth rate. So the debt is increasing from a little under 100% of GDP to an expected 122% by 2034. As it does, it will put upward pressure on the cost of borrowing, which could put downward pressure on economic activity. In other words, debt growth is at risk of not merely persisting but accelerating. Traders often misjudge the market, as seen with recent bets against the S&P 500. Consequently, Mannarino criticized trickle-down economics, calling it a scam benefiting the wealthy. Let's get back to the interview.
Let's just set the stage here. Right now, we are entering a time of a seasonal volatility here in the market. That's number one. This started just about 2 weeks ago. It will play out for the rest of this month. And then secondly, we got geopolitics playing into it. So, and I warned about this 2 weeks ago. I said, we're going to see extreme moves in this market. And that's exactly what has happened here. With regard to the debt market, what we're seeing here, absolutely, you nailed it to the wall. We're seeing a ripple effect of this throughout the markets, including the currency markets here, the carry trade, all that stuff here. What's going on really, and this started weeks ago, we started to see a phenomenon where central banks, they're buying all the debt. They're buying it all. And here in the United States, we've literally watched the 10-year yield fall off of a cliff. As a matter of fact, the action that we've seen here with regard in the United States with regard to the 10-year yield, I never before in all the years I've been in this have I witnessed a drop, such a significant drop in the 10-year yield. Again, what the market is doing, you have to understand, the market is a forward-looking entity. It prices in things that are going to happen, that are actually happening. And this is why traders, for example, traders always get caught on the wrong side and they wonder why. Not always, but generally they will, because they don't understand the dynamics here. The Nikkei, for example, they were calling it a crash. They would say, oh, this is it. This was just yesterday. The market has crashed now today. And then it rebounded like 10%. The shorts got destroyed. Because why? The traders are trying to capitalize in real time. If you're not ahead of it, you're behind it. And you're going to get wiped out. Here in the United States, as another example here, yesterday, a record-setting day for puts or bets against the S&P 500. As we are doing this, the market's up 500, the Dow alone. And these people are going to get destroyed too. It's unfortunate they don't understand dynamics of this market. It's too easy. In fact, it's so easy, it's stupid. So what we're seeing here, this effect of massive asset purchases here. And clearly it's the central banks getting in here. They're buying it all. What is their goal? To be the lenders and buyers of a last resort. They are clearly moving towards that as we move forward. And we're hearing, and you have to understand, and I think people get it here, we're hearing the same nonsense out of both prospective presidential people here. Harris and Trump are selling us the same trickle-down economics nonsensical scam that the whole world is locked into. Every developed nation in this world is locked into some form of trickle-down economics, meaning let's make the rich more powerful and richer, and you're going to benefit from it. Well, how's that working out for everybody? It's not working. It doesn't work. It's a lie. I wrote a couple of papers on this recently, The Lie of Economic Lies. I don't know if you've seen it. Just came out recently, or I go over it, this economic lie that's being forced on people. And I actually suggested an alternative system to it. And I put it out. People went crazy. They're like, wow, Greg, this would actually work. And it would. It's basically opposite of what we're hearing. Trump and Harris are pushing the same economic agenda here. That is lower rates. We promise to lower rates. This is what we're hearing. And a weaker dollar. How does that help anybody? It doesn't. It's trickle down. It helps the 1% and 2%ers while destroying everybody else. That's what we're seeing here. Is it's being priced into the markets. It's rebalancing in many, many ways. But again, this is seasonality. This is geopolitics here. What's going on in the Middle East or may happen at any moment. And look, it's too obvious to me. And it's too simple to understand what we need to do to stay on the right side. People are panicking. Do people actually realize? Of course they don't. Over the last 9 months alone, the S&P 500 is up 25%. Meanwhile, people are going crazy over this 2-day drop, Monday through Friday, that followed through Friday, and then followed through on Monday, because that's what the media does. Oh no, it's scary. Run for the hills. Emergency rate cut. I can't believe that. And you're absolutely right. That they floated out some creatures, and I forget, it probably was every single one of these mainstream media outlets. Emergency rate cut. This would be the worst possible thing that could happen, because it would send a signal to the market that things are very wrong. Things are very wrong. And the faster the economy comes down, I've been telling people this for years, the higher the market's going to go.
The World Bank Commodity Price Index is expected to fall 4% in 2024, following a decline of over 20% in 2023. Silver prices were also forecast to decline by 4% in 2024, which seems impossible after a 40% advance in the year's first half. How do you think the predicted market correction and potential debt market meltdown will impact the future value of silver and gold? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.